All right, gang, so far I talked about market orders, limit orders, and stop loss orders. Or stop orders. Stop loss orders can be used for stop losses or for entries. Usually, traders use stops for stop losses. That's why I say stop losses. But stops can be used for entry and exit. Limit orders can be used for entry and exit. And market orders can be used for entry and exit. Matter of fact, every order I'm talking about right now can be used for entry and exits. So don't just use stop orders for exits. A lot of traders use them for entry when they're seeking momentum and they want the position to move in their direction, or they want proof that there's momentum enough for the stock to, or whatever asset they're trading, to take the position higher or lower if they're using momentum orders to the downside. All right, now let's talk about combining limit orders with stop orders, okay? Now, if you recall, I explained in the last video that when an order gets triggered as a stop order, it actually becomes a market order, okay? So let's say that Amazon, let's use Amazon. Amazon is trading, let's say at 1840, all right? And let's say we want to put a stop order to buy when it reaches 1850. Which is above the current price. And remember, a stop order will allow you to enter above the current price if you're buying, or sell below the current price. So we're not in yet, so we don't need a stop loss, and we're not going short. We're buying Amazon if it reaches 1850. So let's say that we put a buy stop here, and currently it's trading at 1840, right? But let's say Amazon hits 1850. What did I tell you before? The stop order gets triggered and it becomes a market order, okay? So Amazon is a very liquid stock, and the odds are if you place a regular stop order, you'll get filled and the price will be fine. But what if, just hypothetically speaking, this doesn't happen a lot, but it could happen, right? So look at this scenario. Let's say that you get filled, or let's say between the time you get filled on Amazon, let's say that it turns into a market order, and let's say at that second something happens and the price of the stock goes to 1890. Let's say a hedge fund comes in, and right at the time that it hits 1850, a large hedge fund comes in with 1 million shares and it causes the stock price to rise to 1890. It could happen. It's not likely, but it could happen. Guess what? There's a chance that your order can get filled not at 1850 where it got hit, but at 1890. Now, the odds of that happening are really, really low, especially on Amazon, because Amazon is very liquid. But if you're trading a small $5 or a $10 stock, let's say you're trading a $5 stock, and let's say it only trades 500,000 shares a day, okay? And let's say you have a stop order at 550, okay? And let's say a large fund has a stop order there too. Well, that fund can pile in about 10,000 shares, or maybe 20,000 shares. He can do it instantly, right at that same price, and the price will move from 550 to 650 right away. And that can happen very often. It's not going to happen on Amazon, but it'll happen here all the time. And next thing you know, you have an order to be filled at 550, but you get filled at 650 because that's the next higher price. So the question is, how do you prevent using stop orders and getting ripped off? Usually, if you're using liquid assets and you put a buy stop above the current market price or put a sell stop below the current price, the odds are you won't get ripped off. The odds are, if you're trading S&P 500 stocks, if you're trading liquid stocks, but if you're trading illiquid assets, all right, if liquidity is an issue, all right, if they're illiquid, you're going to have a problem. You're going to have a big problem with liquidity, all right? And I don't want you to have a problem with liquidity. So what do we do when we're trading illiquid assets? What we do is we place a stop limit order. So let's say we're looking at that stock again that was trading at $5.50, all right? Or actually it's trading at 5 right now. And we want to buy it if it rises up to 550 on a stop, okay? If it hits 550, we want to buy it. What we can do is we can place a stop at 550 and a limit at 560. So if between the time our stop gets triggered and the price hits above 560, it won't fill us. So this way you avoid those scenarios where the stock goes from 550 to 650 instantly. This way, if the stock goes to 550 to 650, the order will not get filled. It will only get filled if it goes back to 560. So what a stop limit order does is it allows you to use the benefit of momentum when you're placing orders. So if you're placing an order at 550 and it's currently trading at 5, it'll hit once it hits 550, but if you put a limit at 560, it'll cap your exposure to 560 max. Or if you put it at 6, or if you put it at 620, the bottom line is a stop limit puts a cap on your maximum exposure and it corrects the downside of your stop order. So when a stop order gets triggered, it becomes a market order. When you put a limit on it, a certain limit cap, it'll cap it at that price. So if the market goes higher unexpectedly, you won't get filled. And that's the downside. No fill. The downside with any limit order is no fill. The downside with a stop order when there's no limit is you may get filled at a bad price. The downside with a limit order is no fill. So a stop limit, if you choose your limit price carefully, all right? So if you have a stop limit, give yourself a little breathing room. If you have a stock that's a $100 stock, and if you're putting a limit at 101.50, for example, put a stop at 101 here, 101.50, and put a limit at 102, for example. Give your asset a little room to breathe. Don't put your limit order immediately above your stop order. Look at the volatility of the asset and be reasonable. Otherwise, you're not going to get filled. And that's the biggest downside of stop limits. You won't get filled. If you want to get filled for sure, use a stop order. Don't combine it with a limit order. If you want to be, if you're not so certain or if there's a liquidity issue, then combine the two together. And that's a stop limit order. And again, you can use a stop limit order for entries and for exits. If you're using them for exits, be very careful because if a position is going against you and you have a stop limit, that limit may avoid you from getting filled and cause price to go lower against you or higher if you're short. So be very, very careful. In the next video, I'll talk about market orders and GTC orders, day orders versus, not market orders, day orders versus GTC orders. And please, please, please subscribe to this channel. Talk to you soon.